All right, guys, what's up? Let me untangle my microphone here. You know, I always tell myself that. I'm like, you know what? Before I go live, I'm gonna make sure I untangle the microphone. Never happens. It's always all tangled up. So let me do that. But in the meantime, everybody, welcome back to Walks in Wall Street. Hopefully you all are doing well. It is Saturday, March 11th, 2023. It is almost 9 p.m. It's about 8:53 p.m. here in New York City. And tonight, we have the night off. So I think we're going to be going to the Village tonight, specifically Greenwich Village. We haven't been there in a while, so I think it'll be interesting to explore that part of the city. Now, we do have a lot of moving parts with the Silicon Valley Bank situation. And as the days, or I should say as today progressed, I've actually become more optimistic on the situation. A lot of stuff coming out. So we'll talk about that a little bit today, even though the Saturday is supposed to be a little bit sort of our day off, if you will. But, you know, I think there's a lot of moving parts. There's a lot of people who are still really scared, especially, you know, founders who have banked with Silicon Valley Bank. You know, a lot of people can't make payroll, and it's a pretty big mess right now, to be honest. But, you know, I think I should say, I think the private market is going to sort this out, to be honest. I honestly don't think there's going to be a need for some sort of a government bailout. I think there's going to be private entities or larger VCs that come together with other big investment managers and maybe do a little bit of a takeover here. However, the equity holders and the bond holders will be totally decimated, which I think is actually the right thing in this situation. But we'll talk about that a little bit later tonight. But for now, let's say hello to everybody in the chat. Hey, Nicole, happy Saturday to you. Gregory is here, welcome. Fuzzy Dice, there is here, the one and only ABX girl. Sammy Wu is here. Good to see you, Sammy. Thank you for joining. Gary Carpenter. Rally 1965 is here. Neil Bell, Mars Tech, Dr. Longiz. Hope everybody is good, touring different places, buy the book. Good to see you guys. All right, let's head down. Now, here's the good news. Right around, hold on, let me turn down the music. I still have the like the 24-hour live jazz music running in the back. But the good news is the rain stopped. It actually was a pretty nice day in New York. Stopped around 2, 3 o'clock in the afternoon. The sun came out for a little bit. So hopefully it stays that way. And the rest of the weekend will be, well, will be beautiful. Hopefully, let's hope. Hey, Joe Driver is here. Good to see you, Joe. Thanks for joining us. Who else we got? The Garlic is here. Says hello from Russia. Welcome to all of our Russian viewers. Let me press the down button here. I'm going to try to, I think my camera's a little bit off center. Alrighty, team. Yeah, it's a pretty clear night, not too bad. We are reporting live from East 31st Street and Madison Avenue. Give me 2 seconds here. I'm going to try to adjust the camera a little bit. I don't know if that made it any worse or better. I think we're good. Tonight we're going to be walking downtown. But actually, let's head up towards 34th Street because the Empire State Building is lit up. It looks fantastic tonight. Marielle says, good evening, Tom from Ohio. Welcome everybody in Ohio. Good to see you. Thanks so much for joining us. Edward Adams, the storm coming Monday evening into Tuesday evening. FYI, that sucks. Yeah, it wasn't too bad of a day out. It was raining like crazy last night, all throughout the day. Take a look at the Empire State Building here. I see Austin City Limits. Welcome. Good to see you guys. Now, I pretty much spent the entire day on Twitter. Obviously, everybody by now knows the huge debacle that is unfortunately going on with Silicon Valley Bank. We pretty much covered it in depth yesterday about what sparked the bank run, exactly what happened, who is at fault, should there be a bailout, or does there even need to be a bailout? A lot of new information has come out, but I think one of the things I want to set the precedent here is that this is very, very different of a situation from 2008, and we talked about this yesterday, but there's still a lot of people on Twitter that may not be as involved in the finance industry or the tech industry as others, saying that this is very similar to what happened in 2008. And it's actually very different, and I'm not trying to make any excuses or anything like that, but in 2008 there was existential and systematic risk in the banking sector, right? So if you looked at the balance sheets, but first, guys, check that out. That is an awesome shot of the Empire. Love the color scheme on the Empire State Building tonight. It's almost like a baby blue. Super, super bright. I think we're going to take a walk up to 36th Street just so we could see it from a different angle. But if you think about, a lot of the banks during the Great Financial Crisis, their balance sheets were loaded up with like huge toxic assets, right? Which were essentially worth nothing. You think about all the collateralized loans, and you think about the subprime loans that were all loaded up on these banks' balance sheets, which essentially caused them to fail. This isn't what happened in the SVB situation. This was, a classic bank run, right, which we haven't seen in a very, very long time. So there wasn't anything systemic, right, or toxic assets on the balance sheet that caused this crisis, for lack of a better term. What did cause it is a combination of a couple things, right? We reviewed this yesterday, but number one is incompetence in management, right? So as the events have unfolded and as we have more data out, and as we've been really able to take a look at the balance sheet, severe lapse in risk management as it relates to duration risk. And we'll talk a little bit about what I mean by duration risk. We briefly went into it yesterday. It's a little Italy pizza on the corner. But, essentially, there was a huge influx, a huge inflow of deposits into Silicon Valley Bank in 2021 specifically because of everything that we've been talking about here on the live stream, that you had huge amounts of monetary stimulus, fiscal stimulus being injected into the economy, and much of that went into the venture capital space, right? So Silicon Valley Bank is a very niche bank that tends to bank, not exclusively, but it was very, very well connected into the VC market. So if you were a venture capitalist, you probably had your money with the bank and any of your investments, right? So some of the startup companies that you were investing with probably bank with them as well. So as deposits balloon, right? We'll cross the street here just for some context. This is Fifth Avenue now, guys, right outside of the Empire State Building. It's a beautiful night here in Manhattan. But here's the thing, if you understand what a bank is, many people make the very common mistake of thinking that deposits are assets, right? So a deposit, when I go deposit money at JP Morgan Chase, that's actually a liability for the bank. It's not an asset, as many people who may not be as familiar with finance as others may think, the banks take your deposits and it's actually a liability because they have to return it back to you should you want it, right? So banks then take your deposits and they lend it out, right? So they may lend it out in the form of a small business loan. They may, write loans on mortgages. They may lend it out through other different products to try to gain yield. But this bank grew way too fast and way too big in a very, very short amount of time. And they really had nowhere else to put the cash except into mortgage-backed securities and treasuries. Now, here's the problem where I bring up the point of extreme negligence and very, very poor risk management on the part of the C-suite and the risk managers at Silicon Valley Bank. They loaded about $89 billion worth of mortgage-backed securities with a maturity of 10 years, right? So in and of itself there, you have so much duration risk on the balance sheet. And what I mean by that is they should have, and it's always easy enough for, the Monday morning quarterback to say, you should have done this, you should have done that. But, I think everybody essentially in the finance industry agrees that they should have spread their risk across many different maturities, right? It's called duration risk. So instead of just loading up on 10-year, mortgage-backed securities, you should have had multiple other durations in there, because in theory, guys, technically, Silicon Valley Bank is technically solvent should they hold all of their assets to maturity, because the way these bonds work is, for example, if you buy a mortgage-backed security with a 1.5% yield, which is just laughable, by the way, you collect your interest, but once the bond comes to maturity in 10 years, you get your principal back. The problem here is that as interest rates started to go up, obviously depositors are looking for other places to put their money to get better yield, right? So we've been talking on the channel about putting your money in US Treasuries, right? Why would I leave my money in a bank, or why would I buy stocks when the 1-year Treasury is yielding 5%, right? So there's competition there. So they've been bleeding outflows from the bank for a long time now, since September. But up until about 3 days ago, there was, I think, $40 billion in withdrawals in just 24 hours. And that is massive. I don't even think any bank could withstand that. So it has forced Silicon Valley Bank to sell these assets at an egregious loss, like a horrible loss, because, again, I think people need to understand what mark-to-market accounting is. If I buy a mortgage-backed security, in 2021, and the yield on those MBS holdings is 1.5%, well, the Federal Reserve has raised interest rates by almost 500 basis points during that time. So as we know, the correlation between bond prices and yields, as yields go up, bond prices go down, right? There's an inverse correlation there. So Silicon Valley Bank is selling these mortgage-backed securities for pennies on the dollar because they're being forced to, because it was a bank run. So there is a very clear distinction that this isn't a 2008 style moment where the banks were, speculating on toxic derivative assets. They were loading up the balance sheet with subprime mortgages. This actually wasn't the case. These mortgage-backed securities are actually the safest assets out there. They're backed by the U.S. government. But again, it was just a total lapse and incompetence by the risk managers of the bank. They had zero interest hedges on, zero, like none. And they didn't spread out their duration risk at all. So I just wanted to make that quick distinction there. Hey, the Austin Tennis, what's up? Austin Tennis is our former banker friend, now turned tech salesman. Good to see you, my friend. Says maybe I missed it, but what caused the large influx of withdrawals. Yeah, so I think there's two things, right? Now, we'll talk about the influx of deposits first, and I promise I'll get to all the comments here, but it's a very fluid situation. Now, remember probably, well, for all of those who've been watching Walks from Wall Street for a while, you know that we talked about during 2021, there was a huge boom, right, in IPO activity. There was a record year in 2021 for initial public offerings. It was a record year for SPACs, all of this nonsense. And it was a record year for venture capital and private equity as well. That is because liquidity was so high, right? The Federal Reserve printed a bunch of money. There was also fiscal stimulus from the fiscal side of the house. So since Silicon Valley Bank, right, not exclusively, but mostly, right, they have a very, very tight-knit relationship with the venture capital community. There was a huge boom in venture capital investment during 2021. So there was huge influxes of deposits during that time, right? But the problem is, at a bank you would think, you know, getting deposits is great, and it is. At banks you want deposits, but they're liabilities. So you take that money and you have to do something with it, right? You either have to lend it out, you have to make loans, you have to invest it to try to make yield. And since they took on so much money, right? I think at one point they had about $189 billion worth of deposits in such a short amount of time. And if you think back to 2021, you know, yields were, I mean, nothing, right? Factoring in inflation, you had negative yield. So they pile drove almost $90 billion worth of the balance sheet into 10-year duration mortgage-backed securities yielding 1.5% with no duration hedges on, or no duration diversity, right? So they piled in the 10-year maturities, right? So again, going back to my point and Austin Tennis's point, well, what caused all of the withdrawals, right? Why was there a bank run in the first place? Well, it started slowly and then it happened all at once. So think about, you know, put yourself in a depositor's shoes, okay? Let's say if you have $17 million at the bank and it's not yielding anything, right? It's, you know, you're not gaining that much interest. But you look at the treasury market and you're like, wow, you know, a 1-year US Treasury, I could get a risk-free rate of return of 5%. Why don't I do that? So you had a slow trickle effect of outflows from the bank. Not a contagion effect, but a slow trickle effect because money is just naturally moving to where it can get more yield. But then, leading up until about Thursday, there was a couple concentrated, very, very big withdrawals. And again, as we talked about yesterday, the VC and the venture capital community is a very, very tight-knit. Everybody knows each other, all these big firms. So there was some talk on Twitter, and we don't know exactly who started the bank run, right? And I want to be very careful what I put out here on, you know, live stream because it's very fluid. But a lot of people are saying Peter Thiel, and other people said, hey, look, you know, look at the balance sheet of, you know, Silicon Valley Bank. We don't think they're going to make it in the long run. And think about a venture capitalist, right? If I'm a VC, I probably own, right? A venture capitalist essentially invests money into early stage companies, right? So let's say if I invest in a Series A, a company gets their Series A funding, the venture capitalist is probably going to say, great, you use Silicon Valley Bank to do your banking, right? However, if a VC calls their entire portfolio of companies and calls all these founders and says, hey, guys, I want you to take your money out of Silicon Valley Bank immediately. Well, all of these founders pretty much know each other. It's a very tight-knit community. They're going to pick up the phone and say, hey, you know, the LPs are saying pull your money out of Silicon Valley Bank. One thing leads to another. And on Thursday, there was about $40 billion in withdrawals from the bank, right? That is massive. So again, this is just a classic bank run. Was it mismanagement and negligence by the Silicon Valley Bank executive team? Absolutely. However, I think the comparison, in my view, to 2008 financial crisis is not there, because 2008 bank balance sheets were very toxic, right? If you actually, if we be honest with ourselves, banks are really, really solid, right? Not only, the big, you can see the big four, right? JP Morgan Chase, Bank of America, balance sheets are pretty good. It's not like 2008 where they were loaded up with subprime mortgages and toxic derivative bundles, right? It's not like that. So this was a pretty classic bank run. Yeah, so Ryan Beck says, was it a coordinated bank run? So I think there's going to be a lot of information coming out over the next couple weeks. And I'll give you guys my take, and I promise I'm going to read through some of the comments. It's just a lot of information, a lot of stuff coming out. It's very interesting, okay? And I'm not alleging anything, but it's very interesting that the CEO of Silicon Valley Bank sold about $3 million worth of stock freaking 2 or 3 days before the collapse. Now, I'm not saying there was nefarious activity, right? I mean, it's a very sensitive situation. I think we should let the law play out. I don't think it's going to help anybody to point fingers. But it wasn't just the CEO. It was many people that were very, very high up in the company that reported stock sales less than a week leading up to the collapse, okay? And then the people who were pulling so much money out of the bank, it seems as if they were coming from a very concentrated group of individuals. So, look, I don't know if it was coordinated. I don't know. I can't speak on that. But I don't know. What do you guys think? I just think the biggest, misconception here is that this is stemming from another 2008 style system. No, this is just a bank run. We live in a fractional reserve lending system. So, hey, Michael Joseph says, Tom, 90% of the deposits were with startups who burned through cash that was leveraged to ultra long bonds. Well, from my understanding, Michael Joseph, the problem is, yes, if you look at the balance sheet of Silicon Valley Bank, right, many people are saying that, we should let this bank go under because it's a lot of, startups and they weren't going to make it anyway. I kind of have to push back a teeny bit on that, and I'll tell you why, right? The thing is, yes, startups should be able to go under, but not because they put money in a bank and they woke up the next day and their money wasn't in the bank, right? They go under when their business models don't work and sequentially they fail. Now, if you look at the balance sheet, it actually wasn't that much of the balance sheet that was venture debt, right? So venture debt could be priced to wherever they think the portfolio of those companies are worth, right? And it actually wasn't as much as I was thinking. So maybe you guys could pull it up. I tweeted about this all day today. I almost have kind of a headache from it, but I'm optimistic that the situation will play out. But the venture debt, yes, it could probably be marked down significantly. But the problem I see is that if this bank were able to just hold these assets, right, of mortgage-backed securities and treasuries to maturity, in theory there wouldn't be an issue, right? Because the way a bond works is if you buy a mortgage-backed security, you hold it for 10 years, you collect the interest, and at come maturity, you get your principal back, right? The reason why they're being forced to sell these assets is because they're facing a huge windfall of withdrawals, and that's what goes back to the incompetence of not spreading out your risk over multiple durations, right? So they had huge duration risk. So I do see where people are coming from, right? Where they say, the startups, they're unprofitable businesses, they should be able to go under. That I understand, but where I push back is it's not like these businesses, right, are in trouble because, they're burning cash and whatnot. The reason why they're in trouble right now is because they put money in a bank account and then the next day the bank went under, right? That is not, in my opinion, natural selection in capitalism for which company should make it or which company should not. That's a failure in the banking system, which needs to be addressed. And I don't think it actually needs to be addressed in terms of a government bailout. There was a lot of good ideas from a lot of very, very smart people who actually think there could be a bid for the bank by some very big venture capitalists, even, you know, aside from VCs, some hedge fund managers, big hedge funds that could come in and take over the bank, and depositors would be made whole at least, you know, maybe up to 90%. So it's definitely a very fluid situation. BMST Group, this is Silicon Bank, right? Faisal says, was that a rich people bank? So I know, and again, the optics of it, and we could talk about that too, right? Because yesterday, does everybody remember yesterday I said, look, it's going to be a very, very hard sell to the average American or to the American people is if Silicon Valley Bank and other people, you know, lobby the government or ask the government for a bailout. They're going to say, you know, these big VCs, they're super rich, you know, why should we bail them out? And I totally get that, and I actually do agree with you to some extent. I actually do agree. But if you really dig deep and uncover the bigger problem here, this is actually a bad situation because a lot of these accounts, right, at Silicon Valley Bank were not only, yes, very, very large accounts from venture capital firms, but they were the accounts of startup companies who were backed by those VCs, right? So anybody who works at a startup, you know, companies with, you know, even, you know, 50 or less employees, right? Entrepreneurial companies, chances are there's a 50-50 chance, and this is Grand Central Station, by the way, there's about a 50-50 chance that you banked with Silicon Valley Bank, right? For multiple different reasons. And some of the term sheets in these venture deals, they actually made you bank with Silicon Valley Bank. So the problem here is, if I'm a business, right, and I have $1 million and I use that $1 million to, you know, cut payrolls, right, to pay my employees, to pay my vendors, right? Think about the massive downstream effects that this could have. And it didn't happen because these startups were taking crazy amounts of risk, right? It happened because they left their money in a bank account, and due to the mismanagement of the bank, my money's not there. I think that is to no fault of the startup's own involvement, right? But I get it. Like, many people are like, look, if you bank with the bank and you put more than $250,000 in there, that is your risk. You're taking a risk. That is FDIC uninsured money. You should be allowed to be able to fail because you took that risk. I do understand that argument as well. However, I mean, if anybody's operated a business, I mean, guys, even like a bake shop, okay, it probably has more than $250,000 in the bank account to, you know, buy their goods and services, pay their employees, accounts receivable. So, you know, that argument, I do get it, but every business, you know, every single business has over the FDIC limit, pretty much. Let me read some of the comments here. Hey, Roy S., good to see you, my friend. Long time no see. Thank you for joining us. Michael Joseph says they are New York City. Beyond the Matrix, good to see you. Buy the book, says Tom, why do people deposit more money than is covered by the FDIC? They will lose their money outside of the max amount. So again, that is a good point, right? So for those of you who don't know, we'll just do a quick recap. FDIC insurance will cover you in a bank failure up to $250,000. Okay, this is the Yale Club right here, so $250,000. But let's say this, right? Again, going back to Silicon Valley Bank's situation, right? I'm trying to give both sides of the argument here. I'm just trying to give people as much information as possible, and you can make your own conclusions. So let's say if you're a startup and you just raised your Series A, you got a $2 million check, $5 million check, whatever, you just raised some money. You put it in Silicon Valley Bank and you use that money to hire employees, you use that money to cut payrolls, to pay your vendors, right? People have office space, people buy SaaS products to run the business and things like that. That is automatically going to be over $250,000, right? So I see a lot of people, right? And it's a good criticism, I get it. But if you are a large enough business or a functioning business, pretty much every major business in America, you're going to have over that limit in the account. I mean, some people, some businesses, guys, just to cover their overhead a month is like $150 million. So I think the problem now is, and there was a lot of talk about this on Twitter Spaces today, I think the problem now is that if depositors don't have trust in the banking system, where they say, hey, I have $1 million in the account, I saw that Silicon Valley Bank went under, and people are getting 50 cents on the dollar back, 80 cents on the dollar back, well, why would I ever leave my money in a bank? I'm just gonna go buy US Treasuries. And that could cause, on Monday, a cataclysmic and catastrophic bank run across the board, especially at the regional banks. So I think there needs to be something done to nip this in the butt, but I'm actually confident that something will be done. But we'll talk about that later. Keith says, Tom, the CEO of Home Depot said SVB management was not very good, and they took their eyes off the ball regarding their first responsibilities, the shareholders. Keith, that is 100% true. We were actually supposed to head downtown today. So let's actually turn around. Team, we're gonna head to the Village tonight. I wanted to check out Greenwich Village. So Keith is correct, okay? The problem, without a doubt, is that management, and again, we sort of explained this before, but if you look at the balance sheet, and I would implore everybody to do this, right? Look at it for yourself. There was zero, and I mean zero interest rate hedges at all. Right, and you could really whittle this down to duration risk, okay? And we sort of explained what that means, but the biggest problem was they bought about $90 billion, okay? $90 billion or so of mortgage-backed securities with a maturity of 10 years, okay? And we just went through explaining why they had to do that, because they took on so much money from the VC boom in 2021. And the problem is, oh, Miss Brown Eyes, thank you so much for your very kind donation. Appreciate it very much. You're very kind. So the problem is they took a huge chunk of money, guys, almost $100 billion, and plowed it into mortgage-backed securities that are yielding 1.5%, right, with a 10-year duration. So again, as interest rates went up almost 500 basis points, right? The reason why I'm using 500 basis points is because we have the next FOMC meeting in 2 weeks, and we're probably going to get about a 25 to a 50 basis point rate hike, which yields went from 0 to 5%, so that's 500 basis points. So as that happens, right, depositors at any bank are going to be talking exactly like we talk here on Walks on Wall Street. Why would I leave my money in a bank yielding 0 when I could just buy a US Treasury or a 1-year T-bill that's yielding 5%? So you had this slow erosion out of the bank from withdrawals, but then on Thursday you had this massive withdrawal. I think it was like 40 billion, which a lot of people in the chat, and I'm open to this, maybe it was an organized bank run. I don't know if we could say that, but it's just, things are very peculiar. We'll just leave it that way. So in order to meet those withdrawal requests, what do you need to do as the bank? You need to say, okay, well, we don't have the liquidity. So if you think about a balance sheet, right? If you think back to Finance 101, think back to college, you're in your Finance 101 class. A balance sheet is an order of liquidity, right? So you have your cash and equivalents. So they had to sell off
the mortgage-backed securities at pennies on the dollar, right? Because as interest rates go up, the prices of bonds plummet. And it wouldn't actually be a problem if they were able to hold those bonds to maturity, because you would get your principal back. I think there's a fight up here, we'll avoid that. But since everybody wants to get their money out of the bank is forced to sell all their assets, right? We live in a fractional reserve lending system. Miss Brown Eyes, thank you so much for your very kind $20 donation. I appreciate it very much. Thank you for supporting the stream. Let me read some comments. Malcolm says, but how many times do we have to go through this before we can invest? Dan Zhang says, Tom, can a lot of startup firms that use SVB, are they going to be able to make their payroll? Well, that's one of the main concerns that I think everybody's concerned about, right? You know, a lot of these startups, a lot of these startups that invest or that park their, Series A funding and other funding into these banks just to be able to pay the bills, they woke up the next day and are not able to have access to that cash. So it's not like, I get the argument that there's a lot of startups out there that are not profitable. I get it, but that's not the reason why the startup failed. The reason why that they're failing now is because they just don't have access to their cash they left in a bank. I mean, what does that say, right? And I'm trying to give both sides of the story. I'm trying to be as objective as possible. But what does that say for the... Okay, I'll give you guys a better example, right? Think about your personal life. Like if I go to a bank, if I go to JP Morgan Chase, and I put $1 million there that I saved, and if I have to constantly worry about, oh my God, is the bank gonna fail? Like, how does anybody do business in that environment? I mean, money is not gonna flow to the United States anymore if people have to be worried about, bank runs and bank failures and systematic bank runs, right? And I understand, did they take a risk and did they have above the FDIC limit? Yes, but the reality is if you run a company and you have employees, you're gonna have more than $250,000 in the bank. That's just a fact. Team, really quick, this is a gorgeous building right here, Chrysler building, one of my favorite Art Deco style buildings in the city. Right outside of Grand Central Station. TC says, why aren't banks increasing their interest rates to compete with T-bills in an attempt to keep money at the bank? That's another very good point. That's a really, really good point. I think that is actually added to this problem, right? The only thing that I could say is greed. Beacon, New York, good to see you, my friend. Yo, Manny Explores, what's up? Happy Saturday, dude. Hopefully you're having a good weekend. It's been definitely been a crazy, crazy week, man. But good to see you, Manny Explores. Big Picks is if you have lots of money, park it in commercial real estate. Well, here's the thing. That's another thing that's concerning me, right? And not to hammer on this too much because I know we're supposed to have off tonight. But, unfortunately, and the reason why I say unfortunately, and this plays into my thesis, right? And I think I've explained this before. I actually see a really big opportunity coming here pretty soon in commercial real estate, so big multifamily properties and the like, because a lot of those properties, guys, over the last couple of years were bought with floating rate debt. And we've covered this ad nauseum, but a lot of people on Wall Street and on Main Street think the big housing crash is going to come in residential real estate and it's going to be just like 2008 all over again. I actually totally disagree. I think if there was going to be a cataclysmic meltdown in property valuations, it's not going to be the single family homes, okay? People who own single family homes are locked into extremely low interest rates and they could come up with the $2,000. Where it may be cataclysmic, okay, not to scare anybody, but I think there's going to be a lot of opportunities, is the big firms, the Blackstones, the BlackRocks, the KKRs that went in on these very, very big multifamily real estate deals with floating rate debt. Their debt is adjusting to higher interest rates now, and they're not going to be able to raise rents to cover the mortgage payments. So if we think about if this is a contagion effect, right? So let's play this out, which, by the way, I'll preface this by saying I don't think there's going to be contagion. I think this thing is going to be fixed by Monday. And I'll sort of go into why I think that. But if this really is a contagion effect, these banks could potentially call the notes on all of these mortgages, and they're going to go after people who have closer terms, right? 5-year, 10-year. And they could call the note and say, hey, you need to pay us in full. I know you have $10 million outstanding in debt with us. Even though you've made your monthly payments on time, they could call the note. Those things are going back to the banks, and they are going to be distressed sales. And I think that could be opportunity. I don't think that's going to happen. If there's contagion, it may happen. That's what happened in 2008. But I don't think it's going to happen. I actually am optimistic that depositors, I think, are going to be made whole. After today, after being on a lot of calls, I think things are going to be good. Hey, Joan K., good to see you. D is here, welcome. Ryan Beck says, unless they watch Bloomberg or CNBC all day, most people don't know and care. You know, that's true. But what Ryan Beck said, I want to touch on that for a moment, because I was on a Twitter Spaces today with Bill Ackman and a lot of other big players on Wall Street. And even though that comment by Ryan Beck may seem small, like, Main Street doesn't really know about this. Oh, it's very important. I'll tell you why. Because really the only people who really know the severity of this Silicon Valley Bank situation are people either in the tech community or in finance, right? You know, if you, in the flyover states or, in little local communities, pretty much nobody's probably even heard of Silicon Valley Bank, in my view. Now, if this becomes mainstream media headlines, right, if you turn on your local news and you start seeing this, you're going to have your regular local farmer or your local, mechanic out in upstate New York, calling their banker and like, oh my God, should I pull my money out of, XYZ bank, when it has nothing to do with the situation, right? So when we talk about fractional reserve lending, it's all based on the trust of the system, right? And this is why, again, not to sound like a broken record, we're coming up on the New York Public Library here, the Stephen Schwarzman building, gorgeous building. But as we talk about fractional reserve lending, fiat currencies, it's all about the trust and faith in the system. And if nobody has trust and faith in the system anymore, and they say, hey, Silicon Valley Bank is going under, my bank must be at risk too, when they don't even know the situation, right? This situation, to be very clear, has 100%, from my knowledge and my research, been caused by a bank run. 100%. No, it's not like the bank was invested in toxic assets. It was just very, very lapsed judgment and risk management, and there was a classic bank run. So if we can contain that to one bank, I think things will be fine. Hey, Roy S., good to see you. Says, Tom, you put up an interesting clip on your Twitter when a person found out he is fired through the sign in the window. Yeah. Yeah, so that tweet, Roy, was more along the lines of, if there's private investors in here that could come in and take over the bank and the bank can, run as normal. I mean, the equity investors are going to be totally wiped out. They'll be fleeced. The bondholders will be fleeced, which they should. Then the tweet that I was saying is they should totally remove everybody in the C-suite, because you should not be rewarded and you should not be able to keep your job after such egregious mismanagement of a bank, right? And, as we talked about before, there was some very interesting sales, of stock that happened just a couple days before the collapse of the bank. The CEO sold stock, and a lot of other people in the C-suite sold stock right before the collapse. So I think the SEC is going to be taking a close look at that, okay? I'm not alleging anything. I'm not saying there was nefarious activity, but it's a pretty good coincidence, right, guys? I mean, if I'm a CEO of a bank and I sell, $3 million worth of stock. Now, granted, some of that sales was exercised stock options, but still, and then a couple days later, my bank collapses. That's kind of too much on the nose. Would you guys agree? It's a little bit too on the nose, I think. Michael Joseph, so it's not insider trading, but bad ethics. Look, I don't know. Obviously, right, if we're just speaking candidly among friends here, guys, come on. We're not stupid. We're a smart group of people here. If everybody in the C-suite, literally almost everybody, started dumping stock right before it collapsed, we're all sharp people here, okay? We're not stupid. But now, this is what I'll say. I always give people the benefit of the doubt, okay? I know this is a very grave situation for a lot of people, and a lot of people this weekend are under a lot of stress, especially a lot of people I know. So I don't want to point the finger, right? We'll let the process play out, but I can guarantee you, mark my words, you heard it here first, the SEC will be looking into those stock sales. And they better have a pretty good reason as to why they sold stock 2 days before the collapse. Jafet Perez says it smells like insider trading. Can't say. I think, yeah. Michael Joseph says the CEO can usually lawfully sell, but who would he tell? That's the crime. Yeah, so you have two things at play here, right? You have an obvious ethics lapse, but again, let's go back to the main thing that started all of this, right? Well, what put the icing on the cake is there was about $40 billion of withdrawals in one day from a very, very select few amount of accounts. It's a little bit too on the nose. Bree Graham says somebody knew something, potentially. Let me read some of the comments here. Mark Fox says, why do you think about that the media isn't covering the issue? A lot of people didn't know what's happening. Well, I think a lot of people are covering it now. It's all over CNBC, it's all over Bloomberg. It was on Fox News and CNN. But here's what I will say as well, okay? Because I was on a call, a Twitter Spaces, and this is why I say everybody should have Twitter. Twitter is like the best thing ever. It is a free resource to have direct access to some of the smartest investors in the world. And there was a lot of very smart people, okay, and very, very well-connected people that were saying that due to the circumstances, right, of what I just explained about, 30 minutes ago, of that whole dynamic with the mortgage-backed securities, and as interest rates go up, the deposits slowly move out. I'm assuming if you're a CFO of a bank, you're not stupid, right? They probably have all the alphabet soup at the end of their names, this, the MBA, all this alphabet soup. So they're probably smart people. They probably knew for a while, guys, and I would probably guess around September, they knew, because, if anybody's understands mark-to-market accounting, they knew that the value of their MBS holdings were eroding fast. And they probably did the math and they said, look, there's going to become a point if withdrawals continue to a certain amount, we're going to have to start, a fire sale on our assets to cover the withdrawals. And I think a lot of people who are very savvy, right? If you think about who Silicon Valley Bank banks with, it's a lot of venture capitalists and startup founders, so these people are not stupid. They probably looked at the balance sheet and saw the same thing. They're like, wow, they have, 90 billion of mortgage-backed securities with 10-year duration, no interest rate hedges at all. We're going to start to pull our money out of the bank because this thing could be very illiquid and go insolvent. And I think that's what sparked it. So in my view, right, if I had to speculate, and this actually isn't coming from me, this is coming from a lot of other smart people like Bill Ackman and the like, they probably knew something like this was going to happen eventually, probably in September. Right around September, October. Let me read some more chats. Hey, Sunshine NYC, good to see you. It says lots of startup companies weren't making as much money, so too many of them were withdrawing from their savings of the bank and couldn't have enough demand to cover. Yeah, I mean, that's another thing too, right? So, and many people, and myself included, we talked about, 14 years of zero interest rate policy, and we had 2 years of ultra QE, which was just ridiculous. So again, bank deposits grew like crazy, and a lot of these startups were able to operate at a loss because money was very cheap. But as interest rates started to go up, things get a lot tougher, things get a lot harder, and deposits dry up at the bank, right? And since they crowded so much of those deposits in 2021 into these, fixed income assets, there's a problem with liquidity, big problem. Stink Floyd just can't walk around New York City without mentioning the 90th anniversary of King Kong. Well, that is awesome. Happy birthday, King Kong. I didn't know that. Mimi says Google, ChatGPT, the CEOs tie with WEF. I didn't know that. Interesting. All right, let's see what else. Hey, Malcolm, thank you so much. Ryan Beck says, I like the person that bought 200, 160. Yeah, that's another thing. So that's another thing, guys. A lot of people, there was some very unusual options activity, and a lot of people were shorting this stock too, which leads me to believe if this thing doesn't trade on Monday, I don't know what's going to happen with a lot of those put buyers. All right. So we're going to head downtown, team. We are now walking southbound. What was that? We are now walking southbound on 5th Avenue. Herzog says Tom only replies to sheep. I agree. That's why I replied to you. Michael Joseph says news is reporting a lot of SVC startups were crypto companies. Yes, that is true. So when we say SVC startups, right, it's Silicon Valley Bank banked with many venture capital firms that then invested into early stage companies. All right, let me try to get some more chats here. I'm trying the best I can. On my side, the chat is going like a mile a minute, so it's hard for me to stop it and read. Hey, Beyond the Matrix says it's time for these CEOs to go to prison. Well, I mean, if there was any wrongdoing, then I would agree with that. We will definitely see. Hey, Barbara is here. Welcome. Hawaii, good to see you. Michelle K, welcome. What else we got? Marat says, hey Tom, so when is the next big crash coming? So here's what I think, right? And I actually want to know what you guys think. Well, I'll give a prediction, right? Since it's Sunday night for fun. I think we're going to hear something conclusive, either from the federal government or the Treasury, right? I guess that is federal government. The Treasury or the Federal Reserve, we're probably going to hear something by tomorrow night, right? It's either probably going to be some sort of a government bailout, but I actually think that this could be solved without government intervention. I'm not for and I'm not in support of a government bailout. However, if the government does need to step in here, guys, it should be set up in a way, right, where depositors are made whole, equity investors get fleeced, bond investors get fleeced, and if taxpayer money has to be involved, which I extremely disagree with, but again, we have to live in reality. I mean, think about who we have in the administration. If a taxpayer-funded bailout needs to happen, which I actually don't think needs to happen, by the way. I really don't. I think it could be solved without that. It should be structured in a way where we make money on the deal, sort of like TARP, where we actually made money on the deal. I don't think we should be giving out free-for-alls to a bank that essentially went under, right? This is capitalism. This is free markets. However, where it gets a little bit kludgy is this, right? If a big hedge fund or something went under, yeah, no bailouts, no shot. But the reason why it's such a tight spot here is because there's a lot of regular businesses, just normal people that just put their money in this bank, and they have to pay their payroll, they have to, pay their employees, they have to, operate a business. And the reason why they're going to go out of business is because the bank failed. I mean, that could cause some serious systemic ripple effects. So I think this could be solved with a few major players here, a few major venture capitalists coming in here, taking over this bank, potentially restructuring it, firing the C-suite, and then obviously it would have to be recapitalized, in which case the equity investors or the stockholders and the bondholders would lose all their money. And I would be in favor of something like that. But hey, Blues Writer, good to see you, my friend. Thank you for joining. Justin S. says, who do you think is going to step in? Well, right now, the FDIC, come Monday, you're going to be able to get your money back, okay? So up to $250,000, the FDIC is going to be able to write those checks on Monday. The way it works is they then go and sell off the assets, right? Now, the problem is, again, we just had this conversation on mark-to-market accounting. What are those assets worth? I mean, guys, this could be a freaking fire sale where this stuff gets sold for like 60 cents on the dollar. I don't know. But if it goes that way, where it just goes to the FDIC, they sell off the assets and then they try to recover, let's say all of these startups and all these VCs and the depositors get made whole up to 80%, right, through the traditional FDIC way, I think that's still going to cause a big blow to the financial system as it relates to the trust in the system, right? I think that could cause a contagion effect. So I think over the weekend, there's going to be a plan that is drawn up to restructure and recapitalize this bank, not necessarily with taxpayer funds, but the way it's going to work on Monday, right, assuming everything just runs its course, is people are going to be reimbursed up to the FDIC limit. But as a lot of people in the chat have been saying, and this is very important to know, guys, over 80% of depositors at the bank were FDIC uninsured, which means that deposits were in excess or over $250,000, which makes sense because you're banking with venture capitalists who have huge account balances, and you're banking with startups who probably are just depositing their Series A raise or something like that. Hey, Tech Explorers NYC, good to see you. Thanks for joining us, appreciate it. Sting Floyd says we do move them ahead 1 hour. Fast Soul says, will there be mass layoffs because of this? Well, I think if depositors are not made whole, the answer is yes. Right? Because you got to think about it like this, guys, and this is the point I'm trying to drive home. And again, I'm trying to do the best I can to get both sides of the story. But if depositors are not made whole, think about, again, who is the clientele of Silicon Valley Bank mostly, right? It's VCs, and those VCs, companies that they invest in, so early stage startup companies. So this money is being used for payroll, right? So, and if you can't make payroll, what do you have to do? You have to lay off employees so you don't have to pay them, right? So if this bank is just allowed to fail and nothing happens and nobody intervenes, which I don't think is going to happen, then yes, there's going to be huge layoffs in the startup space, and a lot of these startups are going to go under if nothing happens. John says Congress debates getting rid of DST every few years but never acts on it. Skyline 220 says, hey Tom, why didn't these startups with balances over 250K just put their money in money market funds? Wouldn't that have been safer? Well, you have to think about how a startup acts, right? Now, it's different. I think that where people are getting maybe a little bit mixed up is people are thinking about their personal funds, right? So I'm a personal right? I'm not an entity, right? Me, Tom, I have my own personal funds. So yeah, maybe I would leave my money in a money market account. Maybe I would buy US Treasuries. Companies, to a certain extent, they can't do that because money is flowing in and out of the business, right? Let's say if they have to have money in the account to purchase a SaaS product, or have to have money in the account to make payroll, and they use Rippling for payroll, they use ADP, they use, all of this stuff. So yeah, maybe a larger, well-capitalized company would have done that. But I think a lot of these smaller startups, the money that's in the account, like, it's to the tick, right? So if, the $200,000 that's in there probably covers the payroll in and of itself in its entirety. So, it's a lot different than thinking about it from a position of an individual retail person like myself who may have a little bit more flexibility on that capital. But I don't know, those are just my thoughts. Who knows? Like, business banking is a lot different than just regular retail banking. Hey, Patrick, New York City. Good to see you, Patrick. Thank you for joining us. Jay Trader says, I just watched the streaming awards today. I hate to inform you that you didn't win. So sad. Iris Liu, good to see you. Thank you for joining. 45 says depositors should do business with more than one bank if they have that much money. That is true, and I understand that. Also, another thing that was a little bit weird, so to 45's point, allegedly in a lot of the term sheets that these VCs would give out would require, and again, this is just some of the rumors, there's tons of stuff going around, but they would require them to bank with Silicon Valley Bank, right? And again, I think that is sort of adds to the problem, right? This compounds on the problem. But yeah, in hindsight, should people have diversified across banks? Absolutely. And I would say many of them did, right? I've been actually talking to some startup founders myself, to which some have, right? But still, let's say if you're a startup and you have $1 million with JP Morgan Chase and you have $1 million with Silicon Valley Bank. Well, that means you just lost $750,000, right? And that is a huge, that could be life or death for these companies. So I think that's what is making the debate very interesting, whether there should be a bailout or not. Now, again, I've been very outspoken. I don't think there should be government bailouts with taxpayers, but fortunately in this situation, I think the private markets are going to be able to handle this, in my view. Hey, Eliel, thank you so much for your very kind $20 donation, my friend. I appreciate you very, very much. It says, love your walks. We just returned from New York. Hey, awesome, 2 weeks ago. Wow. Can't wait to go back. I would love to live in New York. The best city in the world, no question. Keep up the good work. From Brazil, living in Florida. Hey, awesome, man. So happy you guys got to experience New York City. Very happy about that. Thank you for your support. And please come visit us soon. We'd love to have you back in New York. And thank you for your donation. Very kind. Hey, DM, good to see you. This is Tom. The Empire State Building colors are in honor of the New York City Football Club season opener. Oh yeah, I think somebody emailed me about that. I think that may have been Rick. Is it the, NYCFC? Is that them? I think they may play at a Yankee Stadium, right? All right, so tonight, everybody, we are going to head to the Village. We should be there in maybe about 15 minutes. But if you guys have been enjoying the live stream so far, feel free to leave a like on the video. Hit the subscribe button if you're new. Share the show with your friends. We usually do these lives pretty much every day, starting at 8:30 at night. We don't really have a topic, we just hang out. But tonight we've been talking about the Silicon Valley Bank debacle because this is a significant topic in American history. and I think it's important. So a lot of good conversation tonight. Hey, Paul, says Tom, what's your absolute favorite pizza place in Manhattan? Manhattan, I like Prince Street Pizza. I also like this place called Made in New York Pizza. So it is on the Upper West Side. I think it's on 81st Street in Amsterdam. Very good place, really, really good. But if you're talking about outside of Manhattan, DeFara Pizza is my favorite, but I think they may have closed down. I think somebody told me that. Is that true, everybody? Did DeFara close down in Brooklyn? I could have sworn somebody in the stream said that, but... Hey, the Three Kings. Says, peace, Tom. Hope all is well. Good to see you. Now, I have a question for the chat, right? I have a question for the group here. And first of all, I want to say this. Oh, yikes. There's been a lot of obviously very troubling news and very depressing news coming down the pike, especially with this big bank collapse. But, you know, if you really think about it, and I pretty much spent the entire day today on conference calls on Twitter, right? The Twitter Spaces, if you will. And it really got me thinking specifically that, you know, we talk a lot about this crazy inflation we're having, right? We talk about all the things that are negative and all the things that are bad, but, you know, I was on Twitter Spaces and I was on a call with Bill Ackman, multiple other hedge fund managers that are very, very well respected in the space, Grant Cardone, so many big players, and this is all for free. And I'm sitting there thinking to myself, you know, when my parents were my age, right, in their 20s, the only way they would have access to those type of people, right, for example, Steven Schwartzman, is if they actually worked for the firm or they're close friends or they have family friends. But now, anybody, regardless of your socioeconomic status, regardless of your race, religion, creed, whatever, all you need is an internet connection and to create a free Twitter account, and you can quite literally, in real time, interact with some of the most wealthy, smart, educated people in the world for free. And it just got me thinking, what an absolute freaking blessing that is, right? That really, truly bridges the gap, right? If we want to talk about, you know, all these, you know, wokeness, if we want to talk about it, they keep talking about this equity stuff. Like, that is the bridge, right? Technology is the bridge. It just depends on how much effort you want to put in, right? How much effort do you want to put in to make those connections, reach out? I mean, today, I felt like I got an MBA in finance. Seriously, you know, listening to, you know, Bill Ackman, for example, give out his thesis of how this could go down. Other fund managers who used to be at Citi, Lehman Brothers during the 2008 financial crisis give their opinions on what they think could go down and providing solutions. And it just got me thinking, like, you know, the common denominator or the common factor of all these people that I've noticed, right, that are very, very successful, is they are so relentlessly focused on the solution. This is a really good view here. But they are so ridiculously focused on solutions. They don't get on and they don't bitch about it. They don't point fingers about politics, nothing. The whole conversation, this was like an 8-hour call, was just going back and forth about, this is a bad situation we're in. How can we fix it? And just relentlessly attacking the problem. And as a little bit of an optimistic twist here, right, if you look at data, the reason why people never move up the ladder, right, or the wealth ladder, is because they're around people who keep them down, right? You know, if you grow up in a very poor neighborhood in an inner city and the only people who you hang out with are drug dealers, well, you're going to look up to those drug dealers. But now with the internet, you could literally have a sphere of influence of Bill Ackman, you know, and I'm just saying these people because those are the people who are on the call, but you can take that to any type of community on Twitter. You know, you could, if you want to be a doctor, you know, go to the side of Twitter. There's a whole health side of Twitter where there's doctors that are on calls all day just hanging out, and it's free to join these spaces, right? So it's really just unbelievable. And I was thinking to myself today, imagine where we're gonna be in 10 years. You know, imagine where we're gonna be in 20 years. I mean, if today, literally I could pick up a phone, create a Twitter account, and I could automatically have access, direct access, by the way, where I could go up on stage and ask people a question and interact with them directly. That was not possible any other time in human history, right? Think about that. Being able to literally pick up your phone and have a conversation with Bill Ackman on a Saturday. It's just nuts. So, you know, maybe a little bit of an optimistic twist here is that I do think we're gonna get through this, okay? Is this cataclysmic and is this horrible? Yeah, and I think it could get bad, much worse before it gets better in terms of this Silicon Valley Bank situation. This could be very bad. This could throw the United States into a deep depression. I don't think it's going to, right? I think that this is going to be solved. But even if it's not, I think over the long term, I'm still optimistic for the future. So, if you guys don't have a Twitter account yet, and you don't just necessarily have to be interested in finance, right? You could be interested in anything, be an electrician. There's so many different groups on Twitter where you can interact with each other, and you'd be surprised with just how many very smart, very educated, and very wealthy people are on Twitter that are willing to share their ideas and teach you for free, absolutely free. So I think the real worry down the pike is not going to be inflation, it's going to be deflation. I mean, think about what that's going to do to the traditional education system. That is going to crush it. Hey, Spencer's here, so I'm concerned about this. I'm here in Silicon Valley. Yeah, I mean, Spencer, it's definitely not a good situation at all. And we sort of talked about, you know, what sparked this whole big mess. The only sort of the good news that I could tell everybody is that beyond a shadow of a doubt, this isn't because the banking system is sick in and of itself. This was just a classic bank run. This was a very strange classic bank run. And obviously the management at Silicon Valley Bank, they took on all of those inflows, right, in such a short duration of time, and they invested it in mortgage-backed securities with 10-year duration. So you had such concentrated duration risk, and you didn't spread out the duration risk across the curve, but which we've, you know, talked about almost ad nauseum tonight. Check it out, says this isn't contained. There are other regional banks under pressure. Yeah, so check it out. You're 100% right. The regional banks got absolutely hammered on Friday, right? And the reason for that is this, right? And again, we talk about trust in the system. It's all about trust in the banking system. And the problem that I see is people are looking at the situation and they're saying, oh my God, if Silicon Valley Bank goes under, you know, what does that say for my small regional bank? This is going to be a disaster. And what's going to happen is all of these people are going to have wire transfers going out on Monday morning from all these regional banks to JP Morgan Chase, to Bank of America. And that's not good for the health of the banking system in the United States, is if you just have four main players, you know, the JP Morgans, Citi, the Bank of America, you know, I call them the big four. You know, you need to have smaller players, you need credit unions, you need regional banks, to have a thriving and growing economy, right? Think about all the flyover states. You need bankers that are actually in tune with those local economies on the ground, right? If I'm a banker and I'm making a loan to a farmer, I don't want some guy in New York City doing that. I want a local banker in Ohio doing that, right? That knows the market. So it's very important, and the contagion effect could take place, but again, we live in a fractional reserve lending system, right? This is fractional reserve lending. So it's all based on trust. It is all based on trust. And if somebody in the government, maybe the Treasury, maybe even the president, comes out here and makes a statement to sort of calm the waters, I think that's going to stop a systemic bank run. Because again, I just want to make clear, it's not like 2008 where these banks had toxic balance sheets of toxic subprime loans, right? That's not the case. This is just a classic bank run. Hey, Sam is here. Good to see you, Sam. This is Tom. How are you? Doing very good. Beacon, New York says most of small town America is hurting. Stink Floyd says either discoveries by James Webb. All right, so let's continue to walk down here. Hopefully my battery will hold up as we make it to the village. But we're coming up on Union Square here in a bit. Hey, Pineapple Water, this is Tom. Did you discuss Dodd-Frank? There shouldn't be contagion in the large cap because if there is a run on the bank, they can't put it under the mattress. Pineapple Water. Well, so to piggyback off Pineapple Water's point, I was on Twitter today, and here's sort of the timeline on how things went. Let me just check my battery. So here's sort of the timeline on how things went, right? And then we're going to hammer on what Pineapple Water said. Thursday and Friday, the only people who really knew about this were people who were very, very well connected in the finance industry, always looking at the financial media, right? I think just now, today, since it's blown up so big, it's just starting to hit Main Street. And when it hits Main Street, what happens? It gets political. So you're starting to have a lot of these senators and congressmen and congresswomen come out and say, oh my gosh, I knew there should have been more regulation. Trump shouldn't have rolled back this regulation. And then you have the Republicans saying, you see, Biden is such a failure because we had a huge American bank go under his watch. Biden is an idiot and he's taken so much vacation in Delaware. What an idiot. And it's all getting politicized. But you got to remember, guys, these people are idiots. They're politicians. They don't know anything about finance. So I made a tweet, and I tweeted at AOC, and I feel her plight, okay? But she was saying that the whole reason why this happened is because, the Trump administration rolled back regulations and this and that, and, the banks are over leveraged and this. But that couldn't be further from the truth. The banks are not over leveraged. The financial system in the United States right now, if you look at the banks, are not, are actually like very, very stable. Again, going back to the point, I don't want to sound like a broken record. This isn't the Democrats' fault. This isn't the Republicans' fault. No amount of policy could have prevented this, right? Unless you want to ban fractional reserve lending. If you want to say, okay, we're going to ban fiat currencies and ban fractional reserve lending, this isn't happening. Could you say it's total incompetence on the point of Silicon Valley Bank? 100%. And we literally just went through an hour of roasting the C-suite at Silicon Valley Bank. So I don't think we need to do that anymore. But again, this was a classic bank run. And the reason why it happened in such velocity of why it did is for a couple of factors, right? Number one, the huge concentration of depositors being within a specific sphere of influence that are very, very educated, right? Silicon Valley, venture capital, and startups. So they all talk to one another, and they're very educated people. And I'm going to sort of explain why that matters. Number two is, over the course of a year, we've gone from extreme quantitative easing to extreme quantitative tightening, and interest rates have gone up 500 basis points in that time. So again, 2021, venture capital boomed. It was a freaking free-for-all in venture capital. So as venture capital investment boomed, they bank with the main bank who deals with venture capital, which is Silicon Valley Bank. Okay? So that ballooned their deposits to the tune of $189 billion. And as we went over, right, Finance 101, deposits to a bank are liabilities. They're not assets. I've been seeing so many tweets on Twitter from our own politicians that just don't understand basic concepts of finance, right? Deposits are liabilities, okay? And a bank needs to do something with that money. They need to lend it. They need to make loans, small business loans. They need to make mortgages. They need to, invest it somewhere. This bank was so stupid, right? And I'm trying not to use these words, but they crowded in to 10-year duration mortgage-backed securities of 1.5%, and they didn't have any interest rate hedges on, and they didn't spread their risk across multiple duration securities. So again, as interest rates started to go up, deposits naturally flow out of the bank. Because why would I leave my money in a bank that's yielding nothing when, hey, treasuries look really attractive? Okay, right now, if you buy a 1-year treasury, you get 5% risk-free rate of return. You drop $1 million in a 1-year treasury, you could kick back and make 50 grand a year, assuming you hold it to maturity. Again, I feel like I'm repeating myself, but it's very important that people understand this. This isn't a political issue. No amount of regulation, I think, in my view, right? And again, these are my opinions, could have prevented this. This was a byproduct of extreme malpractice on the side of risk management at the bank and huge moves in interest rates. And I'll say this, guys, if you go to any balance sheet of a bank today, you can check this for yourself. Look at the MBS holdings of a lot of these banks. You look at the regional banks, you look at the big banks, all banks. Okay, I can guarantee you that they also own mortgage-backed securities with, paper losses, assuming they don't hold them to maturity. Because again, as rates go up, the valuations of these bonds get decimated. So all of these banks, right, are holding mortgage-backed securities. If they, assuming that they sold them today, they would have big losses. But the point is, many of the other banks spread their risk across many different assets at many different maturities. This bank did not. And since they were so well connected, and also the VC spigot was completely turned off, there was no venture capital investment in 2022, deposits drained, and on Thursday, for whatever reason, a couple select accounts decided to pull out $40 billion worth of funds, and the only way to come up with those funds is to dip into your assets and sell the assets at a fire sale price, and then you have insolvency. So, I don't know, that's my take. TMB says this is the beginning, not the end of the movie. Potentially. Ryan Beck says, Tom, depending on the market reaction and Fed's reaction in the next couple weeks, we'll see if this was convenient timing or just a coincidence. Potentially, for sure. Hey, Joseph Hardaway, good to see you, my friend. Yeah, Blues Writer says, please use those words. Many bankers are stupid. Well, I mean, I always like to, now here's the thing, it's easy to play Monday morning quarterback, and I realize that I'm doing that, right? I try to be as objective as possible. It's easy for me to say, oh my gosh, and look at this and say, how could you, not have any interest rate hedges on? How could you have so much duration risk in your book, right? it's easy for me to say that. So, but I mean, I've been talking with a lot of people. A lot of my friends are bankers, and they're all saying the same thing. Like, and I'm not a banker, right? I just, I consume myself in the financial world, and this is what I do. It just is like blatant. I don't want to use the term stupid, but yeah, I mean, I don't know how they possibly thought that was okay to do that. I'll just say that. I don't know how it was possible for them to think it was okay to do that. I mean, wasn't there at least one person on the risk management team at Silicon Valley Bank that said, hey guys, there is a pretty big possibility now that inflation is ramping that the Federal Reserve probably is going to raise interest rates, right? But there was a lot of people who bought into the false narrative, right? Remember the big false narrative over the past year that inflation is transitory? Remember that lie? All right, I won't say lie. I kind of got to keep it PG, but I think you guys know what I'm saying. You know what? I'll say it. Yeah, it's a lie. That was a lie. Fed Chair Jerome Powell and all these people said that inflation was going to be transitory, and that was a big lie. And from the looks of it, it seems as if the executive suite at Silicon Valley Bank ate that up. And they're like, yeah, there's no way that interest rates are going to go up. We're going to buy $90 billion worth of mortgage-backed securities that are yielding less than 2%. I don't know. But look, the good news is I don't think we should focus, because here's what's going to happen. This is the last thing I'll say about it. There's going to be so much focus next week, guys, on what did wrong, who's to blame, who sucks, who's this. Democrats are terrible, Republicans are terrible, Trump this, Trump that, Biden this, Biden that. But the most important thing that we should all focus on is the solution to this problem, right? Relentlessly pursuing the solution. Because right now, the reality is, there's startup founders that can't write their payroll right next week. People can't make payroll, right? That's the reality. And the faster that we pivot the conversation to the solution and away from the bickering and away from all the headline nonsense, the better it's going to be for the economy. And I was very, very impressed today to say that a lot of smart people with a lot of money are steadfast working on this problem. And I think it's going to be solved. I think the bank is probably going to be recapitalized. I think the equity holders are going to get fleeced. I think the bond holders are going to get fleeced, which they should. So there is going to be a component of if you took risk, you're going to lose money. And I think things will be all right. E. Smith says Solutions needs to be in a place tomorrow night, or there will be big trouble on Monday morning. Yeah, I mean, E. Smith, I definitely would agree with you. I mean, the sooner the better for sure. Because to your point, I mean, come Monday, if Americans don't have trust in the banking system, to a lot of others' points in the chat, I mean, there's going to be contagion for sure. Frank Garcia says, Tom, with the Silicon Valley Bank have to sell assets at a discount. Well, now the FDIC is in charge of the bank now, right? So technically, and I was making a joke to my friend. I'm like, thank God, the CEO and the C-suite is no longer in charge, right? So the FDIC, come Monday, people will get their money back, up to $250,000. Okay, that is what's going to happen. So if you're going to get $250,000. Right, which is not going to mean much for a lot of people because 80% of the depositors were FDIC uninsured, which means they had more than $250,000 in the account. Then it's going to be a fire sale of assets. But hopefully there can be some sort of a bid for the bank before that because, who's going to want to buy all these assets? Now, I think the mortgage-backed security and the treasury holdings is that's going to be sold in a minute. And I think, they may get like 50 cents on the dollar for that, maybe 60. I think what's in question here, and thank God it's actually not a big of a part of balance sheet that I would have expected, is all of this venture debt, right? So all of these loans to, some of the unprofitable tech companies, which I get, that, is going to go, I don't even know how you would value that. There's probably a lot of people who are smarter than me in the chat that could answer that question, but hopefully there's some sort of backstop that will allow Silicon Valley Bank to hold the assets to maturity, right? So remember, the big thing that I said, and I want to make a point, is that if they're able, okay, if Silicon Valley Bank is able to hold the mortgage-backed securities and treasuries to maturity, they're good. They're good. Again, totally different than 2008. The reason why this bank is going under is not because they have a bunch of subprime loans and toxic derivatives on the balance sheet. It's because they crowded into mortgage-backed securities with no duration diversity. They had so much concentrated duration risk to 10-year mortgages. And again, as rates went up, the value of those bonds plummeted. So I think there's going to be some sort of backstop, some sort of account that is created that'll say, okay, look, Silicon Valley Bank, you can hold the, I think something's going on. Hopefully everybody's all right. There's been a lot of police activity headed downtown. Hopefully nothing went on. But yeah, look, I think that may happen. And again, I don't know, guys. This is so fluid. I know just as much as you guys. But if I had to guess, there's probably going to be some account that's created by the Fed. There's going to be some backstop that's going to say, look, hold the assets to maturity and we'll cover you in the interim. In this way, the taxpayers don't have to foot the bill, potentially. We'll see. Hey, Zach Drew, good to see you, my friend. Thank you so much. Bill Rollins, welcome. Exec99 says, good evening, Tom, and everybody from Illinois. Welcome to all of our friends from Illinois. Good to see you. Now, I want to ask you guys, and I wanted to ask you this before, but we keep getting a little bit off track here. Keith says, Tom, potential / immediate impact to your brother. Yeah, it's a big issue. Totally screwed. And as long as, I would say, as well as a lot of other people too, right? So it's a problem. And again, this goes back to, I wanted to ask this question, it'll sort of tie into what Keith said about, my brother has a startup and they banked exclusively with Silicon Valley Bank. And again, they weren't speculating on toxic derivatives. They just so happened to have money in the bank that went under, right? So that and thousands of other businesses. So when we talk about moral hazard, right? And I'm the first person to say the government should not bail out a private entity. Should not happen, right? I do not believe that we should have capitalism for the profits, right? So privatize the profits and socialize the losses. I think that's unacceptable. So I just want to make that clear. But thankfully, as I said, I think in this situation there may be a way where the private sector, which is going to be probably made up of some big VC firms, maybe some hedge funds, will come in here, recapitalize this thing, and depositors should be good. But I want to know everybody's take on this. Do you think that if the government comes in here and quote unquote backstops it, and this may not even need to happen, but I just, out of a curiosity, do you think that would be considered moral hazard? I want to know everybody's thoughts there, because if the government just willy-nilly comes in here and says they're going to bail it out, I think that's going to send a strong message to the marketplace that this incompetence will be tolerated. And that, I think, is very negative for the long-term ramifications of the banking sector. So I think we need to come up with a solution where it totally wipes out equity holders, totally wipes out bondholders, totally wipes out the C-suite and the employees, unfortunately. And to be fair, I think the majority of the incompetence at Silicon Valley Bank was made at the executive level. There's probably some amazing people, super smart people that were working at Silicon Valley Bank that just got caught up in the mess. Right, I truly believe that. I think the executive leadership really showed the incompetence here. But I don't know, what do you guys think? I'm interested in what you guys think. Hey, Billy Johnson says, is the $250K insurance only for accounts with less than that? No, so what FDIC uninsured means is if I have a bank account with $1 million in it, I only have insurance on $250,000, right? So everybody, in theory, every account is going to have about $250,000 of protection. Anything over that, in theory, you're out of luck. Hey, Zach Drew, good to see you. Welcome. Zach Drew says, let the startups survive and everybody else fail. So that would be a situation where you're making the depositors whole, but you're letting the bondholders and equity holders or stockholders lose all their money. PT Smith, what's up? Says, Tom, do you trust Treasury Secretary who speaks about diversity, equity, and inclusion rather than the debt bank failures of inflation and inflation, says PT Smith. Yeah, I think that's a concern, and a lot of people have been making that, right? Like, where are your priorities, right? Now, in general, generally speaking, do I think people should be treated as equals and everything? Of course. I mean, you'd have to be a sociopath not to agree with that. Do I think there's been this big push of overkill? Yeah, and I think everybody would agree with that, right, if we're being rational. So I think too much of the, in your face, ramming it down your throat could have, taken energy away from actually managing a bank balance sheet appropriately. But, I think every normal, living, breathing American wants equality and inclusion for everybody of all races, genders, and sexual orientations. I mean, that is a given 100%. Absolutely, I'm for that. But do I think that some people are using that as a ploy to gain votes and just political corruption? Yes, of course. I think there's a lot of that stuff going on. Brick Stonewall says, Tom, it's best to spread the money among different accounts across multiple banks. Agreed. Pineapple Water says, Tom, they already have their own backstop with MBS, so Fed acts as a bank for the bank and provides a backstop with interest. They are still solvent. Sabrina Fair, welcome. Good to see you. Oh, I'm running a little bit low on battery here. Black Beauty Machine says, Tom, why not just spread the money across multiple banks under $250,000? Yeah, so it's a good question, right? We kind of already covered it, but it's a very good question. The thing is, when you're running a business, right, it's very difficult. I'll give you an example, like Apple, for example. Apple has billions and billions upon billions of dollars worth of cash, right? Apple can't go, it would be physically impossible for Apple to open literally 100,000 individual bank accounts so they have all their cash in FDIC insured institutions. Now, there's different ways that you can go about it, where there's like sweeps, like overnight sweeps throughout the night that shuffle the money around so you have that protection up to $1 million. But the reality is, if you're running a viable business, even at the startup level, you have about 100 employees, your payroll is probably going to be $250,000 a month, right? So it's so hard to just say, split your money up against a million different accounts. I think it's just kind of almost impossible in a way. Our Bode says, hey Tom, I'm in Miami Beach right now. and happened to find your broadcast when you were here. Hey, very cool. Really commend you on your intellectual analysis. Lucky audience, Robert. Hey, Robert, well, thank you so much for your kind words. I appreciate it very much. And thank you for being here and joining in the conversation. Definitely means a lot. Mrs. Cruz says, oh my gosh, the city seems so quiet. It is kind of a quiet night tonight. Maybe for good reason. We are in New York, where there's a lot of tech startups, so there's probably a lot of people who are a little bit uneasy tonight. Team, right here is the gorgeous One World Trade Center. It's actually a pretty nice night too, pretty clear. Randy the Machines, as if they capitalize, what's to stop depositors from taking their money out? Nothing, right? Nothing. And that's the biggest problem I think we face is, again, this goes back to trust. And it's almost funny because I think this is bringing light to the fact that we run on a fractional reserve lending system. Like, I think a lot of people out there really believe that if you deposit, $100,000 in your bank account, just because you log into your Chase app and you see $100,000, it means that it's in there. It's not. It's actually probably lent out, 10 times over. So, look, is the credibility of Silicon Valley Bank pierced? And even let's say, we do save the bank and we bail it out somehow and it starts to run with new management, who's to say anybody's going to want to do business with them? That's a good point. I don't know. I don't know. I think that's something that needs to be discussed too. Even if the thing is totally restructured with new investors, new management, new board of directors, who's to say that people are going to want to bank with them anyway? That's a good point. I never really thought about that either. Daniel says this is just greed, and more greed. In a way, you're right. In a way, you're right, because you could make the argument, and I think we got to end the stream here in a minute. Apologize. I couldn't charge my phone all the way. I was just on so many calls. My phone was going crazy all day. But yeah, I mean, you could say that during that time when interest rates were low, they wanted to make the maximum amount of money on their money. So the reason why Silicon Valley Bank may have at the time purchased all those mortgage-backed securities at a 1.5% yield is because they wanted to maximize yield. And that particular fixed income product was the one that was doing it at the time. Because remember, think back to 2021, interest rates were near zero, right? So maybe there was an aspect of greed there. Also, if you're a publicly traded company, guys, you have to answer to your shareholders and you have to answer to Wall Street every quarter. Are you going to beat earnings? Are you going to, beat expectations, or are you not? So maybe that was a way for them to sort of show positive EPS or explosive EPS growth at the time. It's a good point. James Keynes says what people are missing here is, unlike the 2008, the Fed cannot cut interest rates to prop up the market this time. I traded corporate credit and credit default swaps in 2008 during the Washington Mutual collapse. Wow. Yeah, I mean, James Keynes, you're right. Let me check my battery. Okay, 4%, so we may go out here. But yeah, to James Keynes' point, he is correct. And to piggyback off of his point that we were talking about, a lot of people on Twitter, again, I'll just say that one more time, are equating this banking collapse to, it's just like 2008. The banks took on too much risk. Well, not really. I mean, if you look at the reason why a lot of these other banks collapsed before is because their balance sheets were loaded up with super toxic subprime mortgages and very collateralized debt obligations and just stuff that was going to go to zero anyway, right? This, in my view, again, was a huge lapse of judgment by management to not disperse your risk over duration risk, right? So you had $90 billion in mortgage-backed securities in a 10-year duration, no duration risk, no interest rate hedges on at all. So as you're forced to sell those assets, right, the value of those mortgage-backed securities are probably trading at 60 cents on the dollar because interest rates have gone up 500 basis points. So yeah, I think the implications are a lot different. Now, if they're able to hold those bonds to maturity, theoretically it wouldn't be a problem. But look, I don't know what's going to happen. We'll see. Team, friends, I want to wish you all a very, very happy, healthy, and positive Saturday night. Hopefully you all get some rest. We will see you all tomorrow, 8:30 p.m. live from New York City for the Markets A Look Ahead live stream, where we'll be covering all the day-to-day activities coming up on Wall Street next week. It's going to be a big one. If you guys are new here, feel free to leave a like on the video. Hit the subscribe button if you're new. Share the show with your friends. And we will see you guys tomorrow in the next one. Sorry for the short live stream, but it was pretty busy today. I didn't have enough time to charge my phone all the way. So Billy Johnson, thank you so much. Zaza, I appreciate you. The Three Kings, Dusty Cole, Neil DM, Sunshine After Rain, Atomic Punk NYC, thank you so much. T-Pack 5000, PT Smith, I appreciate you very much. Sunshine After Rain, Muhammad, Big Pick, Dusty Cole. If you want to connect with us on Twitter, you can follow @WalksWallStreet. I'll probably be active there all night. Maybe I'll be in and out of some Twitter spaces, and maybe I'll create some of my own. And to the Mighty Bull, have a good night wherever you are, because there's always a bull market somewhere, and you just need to know where to look. Have a safe, healthy, happy, and restful weekend, and always stay optimistic. Take care.